Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I trust you're having a great day and you're looking forward to a fantastic weekend as well. In stock markets in the US yesterday, a tremendous rally. Now remember, I have been saying there is likely to be further big tech bear market rallies. But it looked more like a bull market rally on the day. That was big. And if you go into the 5-minute chart, for instance, if you inclined to do so, you'll notice that there's very little pullback in this market. And that's for the S&P 500. And it just goes to show that the whole market jumped on the bandwagon of those big tech results being better than expected. But as I always tell people, they're better than expected because the boards of companies, mature companies, lowball their expectations. I mean, when you're doing a startup, you highball your expectations. But when you're a mature company, you lowball your expectations. So you always look like, well, most of the time anyway, you look like you did better than you thought you would or people would. In other words, you get a gold star, even if the overall performance is less. Now, year-on-year growth in the tech sector is slowing dramatically. And for instance, Microsoft, growth is sort of the mid to high single digits, and yet it's got a valuation of 30 times earnings. It's a very odd tech market at the moment. And we've seen very odd tech markets before. And it doesn't mean when things don't add up in some ways on the investment front perspective that the market isn't going to stop going up. We've seen that before. Bubbles can go to any sort of level. Now, the tech sector isn't in a bubble at the moment, but it's in a bit of an overbought situation relative to earnings, and especially when you consider that those earning multiples are now in an environment of much higher interest rates. So those earnings we've seen before, but at near zero interest rates. So seeing them in a high interest rate environment where the Federal Reserve is going to still hike further is a very different scenario overall. So I caution that a 15% one-day jump in the price of Meta on those earnings results is sustainable. It seems very odd, but we do have equity market buybacks. The Apple price action suggested that Apple might be doing some more buyback as well, and perhaps Meta was doing some buyback of shares on the day as well to just confirm this elevated stock price perhaps, but that's pure conjecture on my part. But it's just the nature of the price action, how it leapt 15% and then stayed there all day. Bzzz. So someone was on the bid in a very big way, and it wasn't just broad market random investor trader behavior happening. Also, of course, as I've spoken of before, we now have one-day options available to retail investors. Good for retail investors, good for you, yet now representing 40% of the daily turnover of the S&P 500. That is becoming a self-fulfilling distortion in the short term that could become a long-term catastrophic distortion for the traders of those options. So just be aware. And always with options, always be a buyer, not a seller. A buyer has limited downside, unlimited upside. A seller has limited upside, unlimited downside. I don't know why anyone ever sells options. They always give a great steady return. Till one morning when you wake up and there's a for sale sign hammering in the front of your front yard as your house is repossessed because you had unlimited downside. Anyway. Tricks for young traders, perhaps. On the economic front, GDP growth more than halved in one quarter, went from 2.6 to 1.1%. And the only real rosy aspect of that really not good, terrible US GDP result was that consumer behavior kept it aloft. Now, we know that supportive consumer behavior was pretty much contained to January, first part of February, and has died away since, which means that it's very likely that, oh, and by the way, government spending went way up in Q1, which makes you wonder, this is the post-COVID period when US spending, government spending should be on the decline back to more normal levels, and yet it's going up. And that could be a secret too to why the equity market has remained so elevated, is that there is still a lot of money finding its way available for speculation. And so hence stock buying even when the fundamentals are not looking good. So that GDP number, US GDP is really not going well. 1.1% for the quarter, dropping sharply from 2.6 to 1.1, likely to drop sharply again. And with that consumer support disappearing there, it could drop quite significantly, perhaps even into negative territory in Q2. But whether it's negative or not, it's not really the point. It's going to remain lackluster to in decline. The Kansas Fed Manufacturing Index collapsed yesterday, severe contraction territory. Pending home sales crashed something like 5% on the month. The US property market is in decline. The commercial market has huge questions over it, hanging over its head. The banking crisis is ongoing. I mean, and talking about the banking crisis, how is it that First Republic Bank can lose 98% of its value, share market value, and still be in business? This is a very odd world we're living in. So, I mean, it was down 98% yesterday, the day before. Now I think it's down 98.5% from its highs. Or sorry, it's down 97.5%, something like that. And it's still in business. I mean, if you said to a major bank 6 months ago, oh, you can lose 98% of your share value, so don't worry about your share value. You can lose 98% and somehow miraculously the government will organize for you to get money to keep operating. Very odd indeed. And again, I don't really see First Republic going bankrupt, but I do see them struggling to continue in their current form. So the banking crisis continues to simmer in the background. There's too much money available in the market for speculation. Clearly, the big tech stocks have had huge leaps that are exaggerated price movements, and we wonder why on those better than expected earnings, albeit. And they've dragged the whole market up with them, but out there on Main Street, it's a crisis. So an economic crisis, it really is. I mean, you've got property prices falling, you've got bond yields likely to still go higher, and they moved higher on the day, regardless of what the Fed does. And the Fed will be hiking at its next meeting, and it's probably going to say it still needs to be careful that it might have to hike again. Especially as this inflation data has remained so firm, particularly on the services side. So the outlook for the US economy, flat at best scenario. So there's real risk there. The global economy continues to slow. We saw that in a host of data over the week. And consumer sentiment everywhere, people say, maybe Germany, business morale, 14-month high. But it's a 14-month high that's still in deep GFC lockdown territory. So, that's the sorts of things we're seeing in that sort of data run. So I would caution that Q2 data for the United States will be below 1%, if not negative. The Fed will be hiking rates. Inflation will remain firm. Large layoffs, corporate layoffs, will be continuing. And this does not add up to 30 times earnings for Microsoft and some of the other big tech companies. So they might have another 24-hour rally, or they may not. They might already be topping out. I think it's a high-risk procedure to be buying big tech at these elevated levels now. And for the broader market, that could mean a exhaustion phase is fast approaching, despite what looked like, I do admit, a bull market rally on the day. I think it could still be a bear market. I hope you have a great weekend. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.